My name is Pat Donnelly. I'm the president of First Mining Finance. We've been to this conference a few times, so I just want to thank the organizers. There's some really good quality companies here. Obviously, I only got 10 minutes, and I don't think that does it justice to hear about the story, but I'll give you a snapshot, and if you have any other questions, please feel free to ask myself or my VP of Investor Relations, Derek Iwanaka. First Mining Finance is a bit of background. It's a relatively new company. It's only been around for just under 2 years. Our founder is a gentleman that you might have heard of. His name is Keith Neumeyer. Keith founded First Majestic Silver, which is the second largest silver producer in Mexico, and it's a $2 billion market cap. And also, he is a founder of First Quantum Minerals. And the common denominator between First Majestic Silver, First Quantum, and First Mining Finance was that Keith founded those two other companies in severe bear markets. And when I came aboard in January of 2015, things were just absolutely rotten out there. We were seeing historically low valuations. The investor community just hated mining. It was toxic. They couldn't stand it. And Keith felt that at the time it was a great opportunity to go out, back up the truck, and accumulate high quality gold assets. And so in a period of just under 2 years, we've done 8 transactions, and we've added 12 projects to our portfolio. Now we have 25 assets in Canada, United States, Mexico, and a market cap of around $450 million. Forward-looking statement, please take a look at that. I will make forward-looking statements. Bit of my background, I'll start with that first. I'm a geologist, don't hold that against me, but I'm also a former sell-side analyst. I was in Toronto for 6 years and 4 years as an analyst. And one thing I've learned in looking at mining equities, and let me be honest with you, mining is a highly risky industry. And I think, you probably hear, it might sound like a bit of a cliche that, oh yeah, you need good management, but because mining is so risky, I think it's even more critical to have strong mining teams. And our founder, Keith Neumeyer, like I said before, he's got a track record. There's not many people in this business that has a track record of Keith. I'd put him up there with the Ross Beatties, the Lucas Lundins, the Bob Quartermains. He's a guy who gets things done. He understands the markets, and most importantly, he creates shareholder value. So that was one of the reasons why I came aboard here, because again, management teams are so critical in the success of companies. Our CEO is a gentleman named Dr. Chris Osterman. Chris is a geologist. He's also my engineer. Chris handles more of the technical aspects of the companies, doing due diligence, managing exploration programs, that sort of thing. My role, I'm a geologist, but I also have a background in the capital markets. So my job is to do the marketing, do evaluations, do negotiations, that sort of thing. So we're a really good team. We work out of the First Majestic office, which is just like a block away, and we have tremendous support from our sister company, First Majestic. What is the strategy of First Mining Finance? Simply, when we were in this bear market, less than about a year ago, we were seeing highly undervalued assets. So the strategy was to go out and take out some of these highly undervalued gold assets. And we were looking for assets that would make money at $1,200 gold. We weren't looking for assets that needed $2,000 gold or $5,000 gold. The market was so broken, you can buy assets that were economic for a very, very low price. We were buying assets for less than what had been spent on them. For example, we acquired a company called Gold Canyon Resources. We bought that for about $58 million, and yet it had over $80 million spent on it. That's how broken the market was. So we are going out and doing these deals. We're not going to put these assets into production. The goal is we'll add value, we'll hold on to them, but at a later date, what we'll do is we'll enter into agreements with other parties, other mining companies, other management teams, private equity groups, where they would take the asset, move into production, and we'll hold on to residual interest in the form of royalties, streams, joint ventures, or a combination of the above, and ultimately pay a dividend to our shareholders. This chart might look familiar. You can see here when we went through a very, very nasty and brutal. Try not to hit anybody here with this laser. Oops. No, that didn't work. Let's go backwards. And I just turned it off. Wonderful. I don't go backwards. Oh, sorry. There's the point. So, when we started this company, we were right here, went down. We've come up a little bit, but we just went through this. And that was one of the worst bear markets ever. So Keith Neumeyer recognized the fact that we're in a very severe bear market, there's a great opportunity to go out and buy assets. So again, it's a matter of timing, it's a matter of having a long-term view and having conviction. And that's what we did when we put this company together in early 2015. I like to call this our scalp list. We're dealing with companies that were basically on life support. You had entrenched management teams. They were, paying themselves a lot of money, sitting on the beach, drinking margaritas, and not doing anything for the shareholders. So in a period of just over a year, we did 8 acquisitions. We went from 0 ounces of gold in the ground to 12 million ounces of gold in the ground. And again, buying these assets for less than $10 an ounce. So I won't get into details on these acquisitions. You can ask me later. But again, we were very, very aggressive in our acquisition strategy, buying high-quality assets. The other thing is, these assets were so cheap, we were buying them for less than $10 an ounce in the ground. And yet, when we have these assets in our pocket, the market values them at $27 an ounce. It was almost like an arbitrage opportunity. So that's another reason why we were being aggressive, because we can do this all night long. Buying these highly undervalued, distressed assets, distressed companies with high-quality assets. If you look, though, at our peers or other developers, they're trading at $50 an ounce. We're at $27 an ounce. So there's a value proposition right there. We're still undervalued. And we have 25 assets, high-quality assets, various jurisdictions. We're diversified. We're almost like an ETF. And again, compared to a lot of other junior companies, we have a very good asset base, lots of ounces, and again, quality ounces. Ounces that would make money in the current price environment. So when we look at assets, we have a very rigorous process for doing due diligence. Specifically, sometimes I get a company calling us up, or I got bankers calling me up, or analysts calling me up, or shareholders calling me up. They say, hey, Pat, take a look at this asset. I think this might fit your portfolio. I'll go in, Chris Austin will go in, we'll look at the public disclosure, and if it makes sense, we'll call the company, and we'll sign a confidentiality agreement. First thing we do is get the drill hole database, get the resource model. I'll be honest with you, I think most 43101s out there are garbage. I don't trust them. So when we look at assets, we strip the resource down to its bones, we rebuild it. Our VP of Technical Services, Bill Tanak, especially these resource estimates. So we will go in there and redo the resource, and we'll use $1,200 gold. If it holds water, then we'll do a deal, and we move very, very fast. Other things is jurisdiction's important. We won't go into places that nobody wants us. We like the Americas, specifically Eastern Canada, Nevada, Arizona, Northern Mexico. We've been looking at Latin America. So far, we haven't seen anything we like. Infrastructure is critical. If it doesn't have roads and power, if you're going to rely on the government for anything, you're wasting your time. I'll never do it. Trust me. So it has to have roads, it has to have power. Land tenure. Obviously, you want good relationships with First Nations, Ejidos. If they're not supportive, we're not going to waste their time. Life is too short, and I've seen too many deals blow up because of that. Holding costs. Often these assets we're buying have had tens of millions of dollars spent on them. Therefore, they require very little in the way of assessment credits or assessment work, and also taxes, that sort of thing. So if it's expensive to hold on to, we won't do it. And the most importantly, valuations. Now that being said, we're buying assets for less than $10 an ounce, but currently we're seeing prices a little bit higher now, $20 to $30. If we see something that's very, very compelling, maybe we'll pay $20, $30 an ounce of a quality asset. Or if the markets pull back, that's good too. We'll pull the trigger. We're always on the lookout for high quality assets. Here's our resource growth. We went from 0 ounces in the ground to 12 million ounces. And again, we built out a high quality portfolio of assets. We're very, very diversified. Most of our key assets are in Northern Ontario. We think it's a great place to do work. We have a great relationship with the First Nations. I just spent a week over in Thunder Bay meeting all of them. They love what we're doing. We hire as many First Nations as possible. We're very forward in our disclosure with them and our communications, and we have a very good relationship with them. I don't take the First Nations for granted. I consider them partners, and I consider them an asset. And so far, that strategy has worked off. We're also in the United States and Mexico. Capital structure, $450 million market cap. We're very liquid, and we have about $34 million in cash. We're on the GDXJ. We just got on to that about a month ago. So creating value, what is the long-term goal of the company? Like I said before, we're not going to put these assets into production. We'll partner up with other companies, and they'll move the assets forward, but we'll hold on to residual interest in the form of royalty streams, joint ventures, or a combination of the above. 10 seconds. News flow, please take a look at that. We've got drilling results, PEAs, resource estimates. We're going to have a lot of news flow going forward. You know, people ask us, well, if you're not doing deals, what are you doing? We're going to move these assets forward, we're going to de-risk them and add value. And then in conclusion, as I said before, you know, you got to have a strong team. We've got a very aggressive strategy for adding assets, very large portfolio, various stages, various jurisdictions, therefore less risk. We're going to do some drilling, add low-cost value, but we'll also continue to do deals. We're very liquid. And when things really turn around in this sector, when gold goes up, we're going to be in a very, very great position to take advantage of that. So I'll leave it at that, and I ran over a little bit, apologize for that. And I'm more than happy to take questions at the booth, just to give people here more time. Thanks very much.